How K and G affect value. As a reminder, to calculate a company's return on equity, or ROE, you can divide its net income by its shareholder equity. Again, return on equity equals net income divided by shareholders' equity. ROE is a measure of a company's profitability and how well it generates profits from its equity financing. A higher ROE indicates that a company is more efficient at converting its equity financing into profits. Shareholders' equity is the amount that would be returned to shareholders if a company liquidated all its assets and paid off all of its debts. It includes retained earnings, which is the amount of profit that is saved or retained and used to pay dividends, reduce debt, or buy back shares of stock. The most relevant ratios that determine ROE are tax burden, interest burden, operating margin, asset turnover, and financial leverage. The retention ratio and return on equity can be used to estimate a company's dividend growth rate, we will call K, which can then be used to determine the effective discounting factor for a company's dividend. Term: retention ratio. Explanation: the percentage of a company's net income that is kept back to reinvest in the business rather than being paid out as dividends. Return on equity, ROE, a financial ratio that measures how well a company is managing the capital that shareholders have invested in it. To estimate a company's dividend growth rate, multiply the ROE by the retention ratio. For example, if a company has an ROE of 15% and a retention ratio of 70%, its sustainable growth rate, SGR, is 10.5%, 15% times 0.7. The effective discounting factor for a company's dividend is the rate of return minus the dividend growth rate. To calculate the discount rate, use the formula G equals return on equity divided by the retention rate, which can be derived by subtracting the dividend payout ratio by 1. The discount rate can be adjusted for risk based on the projected liquidity of the company, the risk of default from other parties, and other factors.